Picture this. It's a Tuesday morning in suburban Phoenix. A couple in their mid-40s, let's call them Mark and Jennifer, are sitting at their kitchen table staring at a piece of mail they just opened. It's from their bank. The letter says their home equity line of credit payment is increasing from $320 a month to $740, effective immediately. Mark's hands are shaking. Jennifer starts to cry. They did everything right. They bought their home in 2019. They watched it double in value by 2023. They used that equity to pay off $28,000 in credit card debt and finally renovate their outdated kitchen. The bank told them it was smart. Their financial advisor nodded along. Everyone said accessing your equity was the responsible thing to do. And now, sitting at the table, they're realizing they might lose everything. The house they thought would secure their retirement has become the anchor that's pulling them under. And here's the terrifying part. Mark and Jennifer aren't alone. There are millions of families across America opening that exact same letter right now, and they have no idea what's about to hit them. Before we go any further, if you want to understand what's really happening in the economy, the things the mainstream media won't tell you until it's too late, hit that subscribe button right now. This is the Wealth Continuum, and we break down the financial realities that matter to your money, your wealth, and your future. Also, drop a comment and let me know where you're watching from, because what's happening in the housing market right now is playing out differently across the country, and I want to know if you're seeing the warning signs in your area yet. Now, let me take you back to how we got here. Between 2020 and 2024, something extraordinary happened in the American housing market. Interest rates dropped to historic lows. The Federal Reserve pumped trillions of dollars into the economy. Home prices exploded upward. In many markets across the United States, property values increased by 30, 40, even 50% in just a few years. Homeowners watched their Zillow estimates climb month after month, and they felt wealthier than they'd ever been. But here's what most people didn't realize. That wealth was paper wealth. It only exists if you sell, and very few people sold. Instead, they did something else. They tapped into that equity. They took out home equity lines of credit, HELOCs, and cash-out refinances. They borrowed against the rising value of their homes to pay off credit cards, buy new cars, fund home renovations, even invest in the stock market. According to data from the Federal Reserve, as of the fourth quarter of 2025, American homeowners have pulled out over $400 billion in home equity since 2020. $400 billion. That's not a small number. That's an enormous transfer of perceived wealth into liquid cash, and it felt good. It felt smart. After all, why not access your equity when rates are low and your home value keeps going up? But now we're in January 2026, and the landscape has shifted. The Federal Reserve started raising interest rates aggressively in 2022, and even though they've paused recently, rates are still significantly higher than they were during the pandemic era. The average 30-year mortgage rate right now is hovering around 6.8%. That's more than double what it was in 2021. And here's where the trap starts to close. Those HELOCs that people took out, most of them have variable rates. They're tied to the prime rate, which moves with the Federal Reserve's benchmark rate. So when the Fed raised rates, those HELOC payments started climbing. What was once a manageable $200 or $300 monthly payment on a $50,000 line of credit has now ballooned to $500, $600, $700 a month or more. Now you might be thinking, okay, that's uncomfortable, but people can adjust, right? They can tighten their budgets. And maybe that's true for some. But we're not just talking about higher payments. We're talking about a convergence of financial pressures that's creating a perfect storm. Let me explain what I mean. First, home prices have started to stall. In many markets across the United States, home values peaked in mid-2024 and have either flatlined or begun to decline slightly. We're not seeing a crash yet, but we're seeing something arguably more dangerous, a slow erosion of equity. If your home was worth $600,000 in 2024 and you took out a HELOC for $80,000, and now your home is worth $570,000, you've just lost a significant chunk of your equity cushion. You're more leveraged than you were before, even though you haven't borrowed another dime. Second, the job market is softening. Unemployment in the United States ticked up to 4.2% in December 2025. That does not sound catastrophic, but it's a noticeable increase from the lows we saw in 2022 and 2023. Layoffs are picking up, especially in sectors like technology, finance, and real estate. Companies are cutting costs. And when people lose their jobs or see their hours reduced, the first thing that gets squeezed is their ability to make debt payments. That HELOC payment that was already stretching the budget, it becomes impossible. Third, credit card debt is at an all-time high. Americans are carrying over $1.2 trillion in credit card debt as of late 2025. The average interest rate on that debt is north of 20%. So not only are people dealing with higher HELOC payments and a shaky job market, they're also drowning in high-interest consumer debt. The financial margin for error is gone. There's no buffer left. And here's the kicker. This is where the hidden leverage trap really reveals itself. When homeowners start to struggle, their first instinct is often to sell the house, take whatever equity is left, and downsize or move to a cheaper area. But here's the problem. They can't. Because in order to sell, you need buyers. And right now, buyers are disappearing. Why? Because mortgage rates are still elevated. A potential buyer looking at that same $600,000 home is facing a monthly mortgage payment that's twice what it would have been in 2021. They simply can't afford it. So inventory is starting to pile up. Homes are sitting on the market longer. And sellers are being forced to drop their prices just to attract any interest at all. Now imagine you're that homeowner. You took out an $80,000 HELOC when your home was worth $600,000. You're now struggling to make the payments because rates went up and maybe you lost some income. You decide to sell, but the market has softened and the best offer you can get is $550,000. After you pay off your primary mortgage, closing costs, and real estate commissions, you're left with barely enough to cover that HELOC. In some cases, you might not even break even. You could walk away from the sale with nothing, or worse, still owing money. That's the trap. You can't afford to stay because the payments are crushing you, but you can't afford to leave because there's no equity left to extract. And this isn't a hypothetical. This is already starting to happen in pockets across the country. I want you to think about this for a second. What happens when millions of homeowners simultaneously realize they're trapped? What happens when the market starts to see a wave of distressed sales, short sales, and eventually foreclosures? We've seen this movie before. It was called 2008. But here's the difference. In 2008, the problem was subprime mortgages and reckless lending to people who couldn't afford homes in the first place. This time, the problem is leverage on top of leverage. It's homeowners who could afford their homes, but then borrowed against them, assuming prices would keep rising forever. It's a different kind of crisis, but it could be just as devastating. Let me take you deeper. The banks know this is happening. They're not stupid. In fact, if you look at the lending standards right now in early 2026, banks have tightened significantly when it comes to HELOCs and home equity loans. They've seen the data. They know that default rates on these products are starting to tick up. According to the latest reports from the Federal Reserve, delinquencies on home equity lines of credit have increased by 18% over the past year. 18%. That's not a small blip. That's a trend. And when banks see a trend like that, they react. They pull back. They reduce credit lines. They freeze HELOCs. And that creates another problem. See, a lot of homeowners were using their HELOCs as a safety net. They had the line of credit available, even if they weren't using all of it, just in case of an emergency. But now, banks are quietly reducing those credit limits or freezing them altogether. So that $50,000 HELOC you thought you had access to, the bank just cut it to $20,000, or they froze it entirely. And now you have no backup plan. You're more vulnerable than ever, and you didn't even see it coming. Now, I know what some of you are thinking. You're thinking, this sounds bad, but the government will step in, right? The Federal Reserve will cut rates, or there will be some kind of bailout or relief program. Maybe. But let me ask you this. Do you really want to bet your financial future on the government acting quickly and effectively? Because if there's one thing we've learned over the past few years, it's that by the time the government acknowledges a problem, it's usually too late for the people on the ground. The relief comes after the damage is done. And here's another angle most people aren't considering: the geopolitical situation. Right now, in January 2026, we're dealing with ongoing tensions in multiple regions around the world. Energy prices are volatile. The US dollar is under pressure as countries continue to move away from dollar-denominated trade. Inflation, while lower than it was in 2022, is still a concern. The Federal Reserve is caught in a bind. They can't cut rates too aggressively because inflation could roar back. But they can't keep rates elevated too long because it's crushing the economy. They're walking a tightrope, and homeowners with variable rate debt are the ones who will fall first if the Fed makes the wrong move. Let's talk about what this means for you. Whether you're a homeowner with a HELOC, someone thinking about taking one out, or even someone who's just watching from the sidelines. If you currently have a home equity line of credit with a variable rate, you need to understand your exposure right now. Go look at your statement. See what your current rate is. Calculate what your payment would be if rates go up another 1 or 2 percentage points. Can you handle that? If the answer is no, you need to start making a plan immediately. That might mean paying down the HELOC as aggressively as possible. It might mean looking into refinancing it into a fixed rate product if you can. It might mean cutting expenses elsewhere to create a buffer. But doing nothing and hoping it works out is not a strategy. If you're thinking about taking out a HELOC right now, I would urge you to really think hard about whether you need to. Yes, your home has equity. Yes, it's tempting to access that cash. But ask yourself, what am I using this money for? Is it something that's going to generate a return or improve my financial position? Or am I just using it to maintain a lifestyle I can't actually afford with my income? Because if it's the latter, you're setting yourself up for disaster. You're taking on debt secured by your home, which means if things go wrong, you don't just lose the money, you lose the house. And if you're on the sidelines, maybe you're renting, or maybe you already own your home outright, pay attention to what's happening. Because this is going to create opportunities, but it's also going to create a lot of pain. There will be distressed sales. There will be foreclosures. Prices in certain markets could drop significantly. And if you're in a position to buy, you might be able to pick up properties at a discount. But you need to be smart about it. You need to have cash or access to financing. You need to understand the local market dynamics. And you need to be patient because this is going to play out over months and years, not weeks. Here's the broader picture. What we're witnessing right now is the unwinding of a decade plus of ultra-low interest rates and easy money. The Federal Reserve kept rates near zero for so long that it distorted every market, including housing. People made decisions based on the assumption that cheap money would last forever. They leveraged up. They took risks. And now that the era of free money is over, the bills are coming due. This isn't just about HELOCs. It's about auto loans, credit cards, corporate debt, government debt. The entire system is over-leveraged. Housing is just one piece of it, but it's a piece that affects tens of millions of American families directly. And here's what keeps me up at night. Most people still don't see it coming. They're living paycheck to paycheck, barely keeping up with rising costs. And they have no idea how fragile their situation really is. One unexpected expense, one job loss, one rate hike, and the whole thing unravels. And when it does, the social and economic consequences are going to be severe. We're talking about families losing their homes, neighborhoods declining, wealth destruction on a massive scale, and unlike the stock market where you can just log off and ignore it, housing is physical. It's where people live. The pain is real, and it's immediate. Now let me show you how this connects to something even bigger that nobody's talking about, the commercial real estate sector. You see, while everyone's been focused on residential housing, there's been a silent implosion happening in office buildings, shopping centers, and apartment complexes across America. According to data from late 2025, commercial real estate values have dropped by an average of 23% from their 2022 peaks. Banks are sitting on hundreds of billions of dollars in commercial real estate loans that are underwater. And guess what happens when those loans start defaulting? The banks get tighter with all their lending, including residential HELOCs. It's all connected. The regional banks are especially vulnerable here. Remember what happened with Silicon Valley Bank and First Republic back in 2023? That was just a preview. Those banks failed because they were holding assets that lost value when interest rates went up. Well, right now in early 2026, regional banks across the country are holding massive portfolios of commercial real estate loans and residential HELOCs that are deteriorating in quality every single day. If we see a wave of defaults, if we see even a handful of these banks run into trouble, the entire credit system seizes up. And when credit seizes up, homeowners with HELOCs who are counting on accessing that credit to make ends meet are suddenly cut off with no warning. Think about the psychological impact of this for a moment. For the past 15 years, homeownership has been sold as the ultimate wealth building strategy. Buy a house, watch it appreciate. Use that equity to improve your life. It became gospel. Entire financial plans were built around this assumption. Retirement strategies, college funding, lifestyle upgrades, all of it predicated on the idea that your home would always be there as a piggy bank you could tap when needed. But what happens when that piggy bank is empty? What happens when the equity you thought you had evaporates and you're left holding debt you can't service? The mental and emotional toll on families is going to be catastrophic. We're already seeing increases in financial stress, anxiety, depression related to money problems. And this is just the beginning. Here's another dimension that's flying under the radar, the demographic factor. Baby boomers, the largest generation in American history, are now in their 60s and 70s. Many of them were counting on their home equity to fund their retirement. They don't have massive 401k balances. They don't have pensions. What they have is a house that went up in value. And the plan was to either downsize and pocket the difference, or take out a reverse mortgage, or use a HELOC to supplement their Social Security. But if home values stagnate or decline, if selling becomes difficult because there are no buyers, if banks won't lend against declining assets, then what? You've got millions of retirees who suddenly realize they're not as financially secure as they thought. They can't afford to retire. They have to keep working. Or worse, they retire and then run out of money within a few years. And it's not just boomers. Millennials, who finally started buying homes in large numbers over the past 5 years, they're vulnerable too. Many of them stretched to afford their homes, buying at the peak of the market in 2022 and 2023. They took out large mortgages with the assumption that their incomes would keep growing and their homes would keep appreciating. But now, with layoffs increasing, especially in tech and finance where many millennials work, they're facing a brutal reality check. High mortgage payments, stagnant or falling home values, job insecurity, and student loan payments that resumed in 2023 and are still hanging over their heads. The financial pressure on this generation is immense, and a lot of them are one bad break away from serious trouble. Let me give you another scenario that should terrify you. Imagine it's 6 months from now, summer of 2026. The Federal Reserve, seeing continued weakness in the economy, finally decides to cut interest rates. Great news, right? Lower rates mean lower HELOC payments, housing market stabilizes, crisis averted. Not so fast. Here's the problem. If the Fed is cutting rates aggressively in mid-2026, that means the economy is in worse shape than we thought. It means unemployment is rising faster. Consumer spending is collapsing. Maybe we're already in a recession. And in that environment, even with lower rates, nobody's buying houses. Banks are still tightening lending standards because defaults are rising. And homeowners who are already in trouble, lower HELOC payments might help a little, but if they've lost their job or had their hours cut, it's not enough. The damage is already done. Or consider the opposite scenario. The Fed doesn't cut rates. Inflation proves stickier than expected, maybe because of another energy shock or supply chain disruption, and the Fed has to keep rates elevated through all of 2026 and into 2027. In that case, HELOC payments stay high or go even higher. More homeowners fall behind, more homes hit the market as distressed sales, prices fall further, and we get the same outcome, just through a different path. Either way, the trap closes. The only question is how fast and how severe. Now, here's where this gets really interesting from a wealth preservation standpoint. If you're watching this and you're not currently trapped in this situation, if you've got liquidity, if you've got savings, if you're in a strong financial position, the next 12 to 24 months could present some of the best buying opportunities you'll see in your lifetime. Not right now. We're not at the bottom yet. But when this wave of distressed selling really kicks in, when banks are foreclosing on properties, when homeowners are desperate to sell at any price just to get out from under the debt, that's when you want to be ready. Cash will be king. The people who can buy without needing a mortgage or who can get financing because they have strong credit and income, they're going to be able to pick up assets at massive discounts. But you have to be patient, you have to be disciplined, and you have to be ready to move when the opportunity presents itself. This isn't about swooping in and taking advantage of people's misfortune. It's about understanding that markets move in cycles, that leverage cuts both ways, and that the same forces that created wealth on the way up will destroy wealth on the way down. If you position yourself correctly, you can be on the right side of that cycle. Let me bring this back to Mark and Jennifer for a second. Remember them? Sitting at that kitchen table, staring at the letter from their bank. What are their options? They could try to sell, but in their market in Phoenix, inventory is up 40% from a year ago, and prices are down 8%. Their home that was worth $650,000 in 2023 might fetch $590,000 today if they're lucky. After paying off their first mortgage and the HELOC and closing costs, they'd walk away with maybe $20,000 or $30,000. That's it. Years of supposed equity growth, gone. Or they could try to refinance, but with their debt-to-income ratio now elevated because of the HELOC and with home values down, they might not qualify. Or they could just try to tough it out, cut expenses to the bone, hope they don't lose their jobs, and pray that things get better. That's not a plan, that's desperation. And the tragedy is, Mark and Jennifer did what they were told to do. They followed the advice of their bank, their financial advisor, the real estate agent, the home improvement contractor. Everyone told them accessing their equity was smart financial planning. Nobody told them about the risks. Nobody explained that variable rate debt could become unmanageable. Nobody warned them that home values could stop going up. And now they're stuck, along with millions of other families who made the same decisions based on the same assumptions. So what's the takeaway here? The hidden leverage trap isn't some far-off theoretical risk. It's happening right now. Millions of homeowners are sitting on variable rate debt tied to assets that are no longer appreciating. They're facing higher payments, stagnant or falling home values, a weakening job market, and limited options to escape. The trap has been set, and for many, it's already closing. The question is, are you going to be one of the people caught in it, or are you going to see it coming and take action before it's too late? I want to hear from you. Are you seeing signs of this in your area? Are home prices softening? Are you or people you know struggling with HELOC payments? Drop a comment below and let's talk about it, because this is a conversation we need to be having right now, not 6 months from now when it's too late. And if you found this video valuable, if it made you think about your own situation differently, do me a favor and share it with someone who needs to hear this message. This is the Wealth Continuum, where we cut through the noise and focus on what actually matters to your financial future. Stay sharp, stay informed, and I'll see you in the next one.